Tax Tips Tuesday on 105.9 The Region.
Okay, with tax season just around the corner, KPMG will be here every Tuesday with Tax Tips Tuesday to help us get started as KPMG and Canada's tax partner, Deol. Dal, how are you?
Not too bad, Jim. How are you doing?
Well, very good. So today you're here to help us avoid making some common tax filing mistakes.
That's right, Jim. And I'll start with RRSP and TFSA contribution limits because it's easy to accidentally over-contribute, and CRA may charge additional tax on contributions. Contributions.
Yeah, that's not good. So how do I make sure I don't go over my limit?
The most important step is to make sure you know what your limit is. For RSPs, your limit is 18% of your earned income from last year, or the annual limit set by the government, whichever is less, plus any deduction room left over at the end of the last year. Your TFSA limit isn't related to your income. Every year, the government sets a limit for how much you can contribute to a TFSA. The program started in 2009, and you can start your contribution in the year you turn 18. So at a high level, your limit this year is a sum of the limits for all the years you've been 18 or over since 2009, minus whatever you've already put in.
Oh, okay. So that sounds like it could be complicated for some folks.
Yes, it can be, but you don't have to calculate these limits yourself. You can find your RSP deduction limit in the RRSP deduction limit statement on your last notice of assessment, or if there have been changes since CRA sent your notice of assessment, CRA should send you a form with your new limit. Your TFSA and RSP limits are also available on My Account on the CRA website, on the My CRA mobile app, or you can get them by calling CRA. I want to add that one area that catches people on RSPs, that it's not just the amount you put in your own RSP that counts towards your limit. What you and your employer put into your pension plan and what you contribute to your spouse's or common law partner's RSP will also count towards your limit.
Right. So you have to keep track of what's going into all of those things, not just your own RSP.
That's right. Another area, Jim, where we see tax filing mistakes is around people's principal residence. If you sell your only principal residence, you don't have to pay tax on any gain from the sale, but you can't just sell the property and then not pay tax on the gain. For the gain to be tax exempt, you have to fill out Form T2091 to designate that property as your principal residence, and you have to report the sale.
Okay, I see. So the gain from selling the property isn't officially tax exempt until you filled out the forms on your return.
That's correct. And finally, if you own foreign assets that in total cost more than $100,000 any time in the year, you need to file Form T1135 with your tax return and provide details. In this case, your foreign assets don't include your winter place in Orlando or any property you have for running a business abroad, but they do include U.S. equities. So if you bought a lot of U.S. stocks, you may want to look into this.
Well, as always, thanks for the tips, Dal. We'll talk again next Tuesday. In case you missed this week's or last week's Tax Tips Tuesday, go to our Twitter feed at 105.9 The Region, or as always, kpmg.ca.
Tax Tips Tuesday with KPMG in Canada on 105.9 The Region.